Ever wonder how some traders seem to know exactly how to adjust their option positions as the market moves? It's all about understanding the option Greeks. Keep watching to see how they can help you manage risk and lock in profits. In this video, we'll break down the 4 key Greeks: delta, gamma, theta, and vega, a set of option metrics. We'll show you how the Greeks can help guide your option trades based on your market view and how they might signal when it's time to adjust your strategy. The Greeks are tools that help you understand how an option's price might react to different market factors like price movements in the underlying stock, time, or changes in market conditions. They don't guarantee outcomes, but they can give you a clearer picture of the potential risks and rewards in an options trade. Delta tells you how strongly an option reacts to a change in the stock price. Same move in the stock, very different response, depending on the option and the market backdrop at that moment. Think of delta like how responsive a car is to the gas pedal. In one car, a light tap and you're off like a rocket. That's a high delta. In another, you can press down hard and it barely moves. That's a low delta. As a rough guide, a delta of around 0.7 or higher is considered relatively high. The option's price moves significantly with the stock. A delta of around 0.3 or lower is considered relatively low. The option's price moves more gently, and it may cost less. And here's a trader's shorthand that some people find helpful. A delta of 50, traders often drop the decimal point, is often seen as a 50-50 chance the option will finish in the money. A delta of 20, roughly a 20% chance. It's not a guarantee, just a quick way to think about the odds baked into the price. One more thing. Call options have 0 or positive delta. They gain value if the stock goes up. Put options have a 0 or negative delta. They gain value when the stock goes down. Delta doesn't make predictions, but it can give you a feel for how responsive an option might be to a change in stock price and help you make decisions based on what kind of ride you're planning. Now let's look at gamma, the Greek that tells you how much the delta itself is likely to change as the stock price moves. That gas pedal response we just talked about is not always consistent. Imagine a car that's been driving for hours. It's warm, smooth, and highly responsive. But first thing on a cold morning, it might feel sluggish. Gamma measures that shift in responsiveness. High gamma means delta could change a lot. Your option might react very differently if the stock price moves at different times and under different conditions. Low gamma means delta is steadier and more predictable when circumstances change, less likely to surprise you. As a rough rule, gamma tends to be highest when the option is at the money, and it decreases closer to expiry. Next is theta, the Greek that measures time decay. Options lose time value as time passes, and that loss speeds up the closer you get to expiry. Think of it like a concert ticket that you're looking to sell. A few weeks before the show, it still holds most of its value. But as the date gets closer, the pressure to sell builds and the price drops quickly. An hour before the event, if you haven't sold it, it's likely worth much less. That's what theta measures. The time value doesn't just fade, it accelerates towards 0 as the clock runs down. Generally speaking, theta tends to be largest for at-the-money options with less time until expiry, exactly when time pressure is highest. Finally, there's Vega, the Greek that tracks how sensitive an option's price is to changes in implied volatility. Implied volatility measures how much a stock might move, whether that's up or down. And Vega tells you how much an option's price could rise or fall when the market starts expecting bigger moves ahead. One way to think about it is insurance pricing. If the weather looks calm for weeks, premiums are low. But if there's a chance of a major storm, even if it hasn't hit, the cost of insurance jumps. Options work the same way. When expected or implied volatility rises, option prices go up. That's what Vega measures, the option's reaction to changing expectations. As a rule of thumb, options with more time until expiration tend to have higher Vega. So do options where the strike price is close to the current stock price. Let's pull it all together in one example. Say you're looking at a call option on stock ABC. The stock is trading at $50. Imagine that the option has a delta of 0.5. If the stock goes up $1, the option is expected to gain about 50 cents. A gamma of 0.04. If the stock rises, delta could increase from 0.5 to 0.54, meaning the option becomes more responsive to price changes in the stock. A theta of negative 0.03, all else being equal, the option loses about 3 cents in time value per day, just because time is passing. A Vega of 0.1, if implied volatility for the stock increases by 1%, the option's value could rise by about 10 cents. Understanding the Greeks can help you map out how an option might behave, so you can plan your trades more thoughtfully and manage your risk more effectively. If you want to dive deeper into how options work, check out our course on how to trade options and our full article on the option Greeks.